Hi, I'm Kep Kepner CPA here in Dallas. We're talking about one of my clients. We're calling him alias Roger, who owed 300 and paid 300,000 in taxes this year, including about $15,000 of penalties. And he was certainly upset about having to pay that much in tax. He said it just doesn't seem right. I'm paying the high tax rate of 39.6%. Well, the fact of the matter is, at his 900,000 in earnings, he's in the top 1% of the taxpayers in the United States. And as that group of taxpayers, the top 1%, is paying 38% of all the taxes. The top 5% of all taxpayers, now we're getting down to people who earn maybe 200, 300,000 a year. All of that group, the top 5%, pays 65% of all taxes. So you're living out in a suburb in Dallas, Frisco, or somewhere. You're living in a nice $500,000 home. Life is good. You're making a $200,000 income. You're barely able to get that done and provide all the things you want to for your family, the new cars, the kids' soccer team expenses, the school books. You're worried about planning for college. Well, you're in that group where the top 5% of the taxpayers are paying 65% of all the taxes in the United States. So you probably have a reason to complain. But your answer is you better earn more money. Because if you're struggling to get by on 200,000 and you have yet to save for your college education, then you better earn more money, even though you may earn more and have to pay more in tax. So there's a real balance in planning your tax life and your financial life, which we can help you with. So my client, alias Roger, who made 900,000, we kept talking about what can he do about it. That's ordinary income. Well, there are strategies that can be implemented where you invest that income even in your own company or maybe outside of it in types of investments that you can then sell and take capital gains income instead of ordinary income. In alias Roger's case, that difference in the tax rate is 20% for capital gains as opposed to 40% for ordinary income. So as we examine what he's doing in his business, maybe he can invest in a product that he can sell differently, not as an ordinary income product that he sells through his business, but maybe he can develop a product that he can sell that part of his business to somebody else, and it might be a capital gain. And in that case, he's got a chance to realize big income at a low tax rate. That's hard to do. There are a bunch of tax scams that are out there to try to cause that to happen for taxpayers, and you got to be really careful about that. In fact, there was a case of a man who owned a company that he sold to Google. And part of his strategy was that he was to end up owning 3% of his company. Well, as it turned out, there were a bunch of various stock options and other things, and his percentage of the company went down from 3% to around 1.5%. He went to Google, actually, and said, I'm supposed to be at 3%. Pay me the rest of that money to get me up to the value of that. So they paid him $850,000 in cash. He reported that as a capital gain because that was his plan, to be a 3% owner. Unfortunately, he lost the battle at the tax court. The IRS basically sued, or he sued the IRS and said, this is capital gains. They said it's ordinary income. He lost at the tax court. He's now in district court. If he wins, then he's won a big thing. He's won $160,000 in less tax. So that's a big win for him, less his attorney fees. On the other hand, if he loses, not only does he pay the full 40%, but penalties for being late, and so he has a much greater impact by having it as ordinary income. So very often these strategies to move something from ordinary income to capital gains might be a great strategy, but it's really difficult to do within an operating company. So if you need help in planning that, we can give you a hand. Give us a call. Thanks.